Emergency fund and spicy curry have exactly what in common? Let's talk about that in this video. A recent study in the UK found that about 34% of adults had either no savings or less than £1,000 in a savings account. A Bankrate survey of about 1,030 individuals in the US found that more than half of American adults, about 56%, lack sufficient savings to shoulder an unexpected $1,000 expense. According to a Eurostat report, the gross household savings per capita in the European Union was just 2,723 euros just a couple of years ago. The financial roller coaster doesn't stop there either. In Asia, let's take Japan for example, an SMBC Consumer Finance Survey assessing the financial awareness of people in their 20s to 40s has revealed that approximately 20% across that age range have zero savings. The middle class, pretty much across the world, is drowning in debt and is being suffocated by the lack of basic financial education to have at least some decent financial cushion for emergencies. Because where there's chaos, there is always opportunity. And that's exactly where I come in. So, ladies and gentlemen, boys and girls, welcome to the newest hands-on channel on YouTube. My name's Divya, and before you ask, yes, I'm Indian, but no, I won't be fixing your computer or showing you the latest Bollywood dance moves, unless you ask nicely, of course. I want to discuss something we all have in common. And no, it's not the dreaded aftermath of indulging in a fiery Vindaloo curry on London's Brick Lane. It's something even more universal, our old friend, money. Because let's face it, just like that Vindaloo, mishandling money can leave you with a bad tummy and a regret in the morning. Whether you're Indian, American, Ameribrit, or somewhere in the middle, Australia, hey, we all want to make those dollars and pounds stretch a little bit further. Am I right? And let me tell you, growing up with an Indian mom and dad, I learned the value of dollar faster than you can say compound interest. My aim here is to navigate together with you this financial maze and emerge more confident and less stressed, armed with the knowledge and tools to tackle any sort of financial curveball that comes your way. Because let's face it, when your emergency fund can't even buy you a decent cup of coffee, you know you're playing with financial fire and it's time to turn up the heat. Now, let's dive into the heart of the matter, the nitty-gritty of emergency fund management, the multi-tier strategy for building the ultimate emergency fund that I like to call the peace of mind fortress. I designed and used this strategy to build my current $70K plus emergency fund in 2 years from scratch while going through an expensive education, a number of financial setbacks, and a global medical. You know, it sounds like endemic, starts with a P, but YouTube goes Lulu if I say it. Let's dive in. You see, I approach tackling financial stress with the construction of an emergency fund using a multi-tiered strategy like I mentioned before, each level serving a specific purpose. Let me break it down for you in a way that's easy to understand. Tier 1, low-rate personal savings account. The trustworthy low-rate savings account. Your reliable sidekick in times of need. Hey, let's start with the basics, shall we? What exactly is a personal savings account, you ask? Well, these are usually the simple savings accounts offered by traditional legacy banks. It's a symbiotic relationship, really. You deposit your money, the bank borrows it, pays you a small interest, and lends it out at higher rates. You essentially get a fraction of the interest for lending them your funds. I've popped a link below in the description box if you want to learn a bit more about these savings accounts. Now, the best practice is to open a savings account with the bank where you usually hold your salaried account just for ease of operation. These accounts typically yield low interest rates, usually 0.5 to 1.5% in advanced economies and around 4% to 7 plus percent in emerging economies. By utilizing these accounts, you, number one, have immediate and risk-free access to your money whenever you need it. Number two, enjoy the peace of mind of your funds being held by well-established banks, whether it's HDFC, SBI, NatWest, JP Morgan, or any of those other similar banks. But hey, you're probably wondering, how much should I stash away in this fund each month? Fair question, but I'm glad you asked. I'll cover all the specifics on capital allocation in my next video, so make sure to subscribe and hit that notification bell to stay in the loop. Tier 2, high return government guaranteed funds. Whoa, 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 whoa. What's all that jargon? Don't worry, let's keep with the ABCs of it first. What are government guaranteed funds? These funds keep your money in a holding of government backed short term loans. When those loans are repaid, they come with an interest, which gets passed on to you. This tier offers immediate accessibility with medium risk, ensuring you can tap into your funds at a moment's notice without sacrificing liquidity. Now, how do you go about investing in these funds? You can either use traditional legacy banks where you have your savings account, or opt for a neo or an online bank like Revolut, or even intermediary fintechs like TransferWise. Neobanks and fintechs often offer better rates since they operate with lower overhead costs without physical branches. Why medium risk, you might ask? Here are a few key risks to consider. Number one, governments can default on their debt obligations. That's why always opt for funds linked with stable economies or governments such as the US, Europe, or Singapore. Number two, interest rates for these funds can actually drop to zero or even go negative. Though highly unlikely, it's still always good to keep this in mind and to check the interest rates regularly. Number three, only a fraction of amount of your money in these funds might be insured. That's why always check what proportion of your funds are actually insured by the likes of FDIC or FCA. So, how do you proceed? First, compare online institutions and traditional banks to find the ones offering government guaranteed funds with the best interest rates. I found that online institutions like SoFi Technologies or Revolut or TransferWise offer competitive rates on USD or EUR or GBP. Since I live in Europe, I chose to spread my money between Revolut and TransferWise, both European entities. As an example, at this point, on my euros, I get around 3.11% interest with my Revolut and about 3.67% with TransferWise, which, to be honest, is fairly good. Does not exactly beat inflation, but still, I keep making a fairly decent return on my money without really breaking a sweat. So you might be wondering, right, David, what's really the difference between Tier 1 and Tier 2? Well, there are really two key differences. Number one, type of the asset. So Tier 1 is a traditional savings account with a traditional legacy bank, like I mentioned before. But Tier 2 is basically your money being invested in a government debt fund. See the difference there? The difference number two is, of course, the interest rate. So just wanted to quickly repeat this. Tier 2, which is high return government debt guaranteed funds, usually give a higher interest rate on your money as compared to Tier 1, which is traditional low rate interest savings account. I hope that makes sense. If you have any questions, drop them in the comment below. Now, though I mentioned this earlier, but let's revisit the risk with government debt funds. Even though the debt funds are generally speaking safer with advanced economies than with emerging economies, in tough times, these interest rates can indeed go negative. So that's why it's always important to follow the changes in rates, which usually are tied to the central bank rates and the debt paying capabilities of individual countries. Now, you might be wondering, how much should I save? Or what should be my target amount in the emergency fund? It's a common concern. And there is no shortage of those sort of generic rules floating around on YouTube, like 50-30-20 rule, 70-20-10 rule, or 40-40-20 rule, so on and so forth. But let's face it, these one size fits all approaches often miss the mark. There's no magic formula that suits everyone's financial situation. So here's my perspective. Forget about rigid rules and arbitrary percentages. Instead, focus on saving whatever you can, whenever you can, while still maintaining a comfortable living standard. It's about striking a balance between financial security and enjoying the present moment. When should you access your emergency fund? Tier 1 is your go to for immediate needs, such as a spontaneous trip to visit family or any other unexpected expense that requires sort of that quick cash. You know what I mean? Example, imagine if you need to rush to the other side of the world to meet your parents, but you don't have enough funds in your current account for those plane tickets. That's when you dip into your Tier 1 emergency fund. Tier 2 emergency fund, on the other hand, should remain untouched under normal circumstances. Reserve it for truly critical emergencies like a major medical expense or significant financial crisis. It's your safety net for when things get really, really tough. On level 3, we have investments. While this tier carries higher risk, it also offers the potential for greater returns. The goal here is to make your money work harder for you. And the trick is to find, number one, very low cost investment platforms, for example, international brokers, eToro, etc. And number two, to find very low cost ETFs, for example, VOO, which basically tracks the S&P 500 index. By putting a small percentage of your money into investments, you can really leverage the power of financial markets to make fairly decent returns over a long period of time. However, before investing even a single dollar, there are a few things that you have to consider. Number one, are you mentally ready to lose all your invested money? Yes, investments can go down to zero, and I have been there. Number two, if the investment does go to zero, how badly does it impact your day to day finances? Number three, can you consistently put aside a fixed percentage of your income into investments every week or bi weekly or monthly? If not, that's okay. But make sure that you never end up in a situation where you have to liquidate your investments. Remember, tier 1, tier 2, and then tier 3. Now, some might say that, hey, investments can't be categorized as emergency funds. Fair. I understand. And to a certain degree, I even agree to that. Most of the money gurus out there keep investments and emergency funds in separate buckets. That's okay. That's their thing. But I truly believe that both those buckets serve the same purpose: access to money when you need it, depending, of course, upon the level of emergency, right? Do you agree with this? Then give this video a thumbs up. If not, I would love to hear your thoughts in the comments section below. So, the way I see it, if you are invested through a low cost exchange which offers quick and free withdrawals or low cost withdrawals, then when times get really, really tough, or even if you need extra capital for those large purchases like a house, for example, you can dip into this tier 3 bucket to manage those sort of situations smoothly. Ultimately, it's about how quickly you can get access to your cash in those sorts of situations. It's your money after all, and it needs to be deployed when you really need it, right? But hey, how much money should you put in each of these three buckets? I will definitely cover all specific details for capital allocation in my next video. So, as you journey through the peaks and valleys of personal finance, remember this: with the right strategy and a dash of determination, you too can weather any storms that come your way. And I'll say it once, I'll say it again: save without specific goals, deploy savings mercilessly when needed, and above all, stay consistent. Because when it comes to financial security, there is strength in numbers and consistency is the key. This is all for now, guys. I hope you enjoyed this video about the importance of having emergency funds as well as the importance of picking the right curry restaurant in London's Brick Lane. If you liked what you saw, stick around and find out more, and I'll see you in the next video.